Chapter 5 of Auditing, we talk about legal liability. So the first thing it talks about is the ever-changing legal environment. So with businesses getting more and more complex from a standpoint of they're larger, they're more international, there's the volume of accounting transactions, and then just, the ever-changing parts of our economy going up and going down and all that stuff, and of course more and more lawsuits. So all of that makes it a much more complex legal environment for businesses and auditing firms or accounting firms to do business in. So it talks about the three different types of kind of the risk involved. So there's a risk that there could be business failure. So the business that's being audited is going to end up going bankrupt or going out of business and unable to pay both their bank loans or give any money back to their shareholders. So a lot of times when businesses do fail and the stockholders can say, hey, these audited financial statements showed no signs of concern, and that's what I used for my investment, many times the investors can then kind of come back on those auditors to say you should have uncovered it or you should have seen something. So there's a risk involved there. Then there's a risk of just the audit failure, that the auditor just doesn't do their jobs as properly as they should or as competently as they should, and they end up issuing an incorrect opinion on those statements. So again, maybe their materiality levels weren't great. They didn't, test the right things. They didn't see any of the signs that this business could be going under, but maybe should have. So that would be an audit failure. And then there's audit risk, that the work will not uncover the material misstatement. So again, so like when, to look at the difference between those two is that the audit failure is that the auditor issues an incorrect opinion because they failed to notice material misstatements. The audit risk, it says specifically that it represents the possibility that the auditor will conclude after conducting an adequate audit that the financial statements were fairly stated when in fact they were not. So I kind of feel like audit risk and audit failure kind of go hand in hand, but maybe the audit failure again is because they didn't actually comply with auditing standards, where the audit risk is like they did everything kind of as they would have expected to, but then they just made the incorrect, gave an unqualified or an unmodified opinion when really there was something there. Because then it says like the auditor may still fully comply with those auditing standards, but fail to uncover a material misstatement due to fraud. So again, those, they're very similar, but they're all kind of a risk involved with the auditor. So then we get into our next section, which is the legal concepts that impact liability. So the prudent person concept, or like back in business law and ethics, we would say a reasonable person. So it's kind of the same thing, that the auditors are expected to use and exercise due care when they are going through the audit and issuing out their opinion. The issuing of that opinion is not a guarantee that the financial statements are free from any material misstatement. And then again, it's like a reasonable person or a prudent person. What would they use those financial statements for? And that's kind of what the auditors are looking at to say that they are, they're being expected. A prudent person would expect them to use due care, not necessarily be perfect. Then we have the liabilities for the acts of others. So the shareholders of a corporation could be all liable for the civil actions against the owner. Again, depending on how they're set up, are they a limited liability partnership, a LLC, a general corporation? All those business structures are going to kind of dictate what that liability for one owner's actions over another one. So the partners, again, could be liable for the for the negligence of another partner within that audit firm. And then they also could call on specialists that they could then be liable for those people's performance as well. The lack of privileged communication. Again, if the court ever subpoenas a CPA, they would have to disclose whatever information they uncovered in that audit for that court subpoena. Then other sources of legal liability. Again, there's a liability to the clients, the audit clients. There's a liability to third parties who use those audited financial statements. There can be a civil liability under federal security laws. So again, going back to if they're stockholders and they use those financial statements to base their decision to invest in that company. And then finally, there can be criminal liability. So depending on what the if it's fraudulent financial statements, those types of things, people can actually go to jail for those crimes. So then we get into, again, a little bit more details of the auditor's liability. So they could sue for breach of contract, which would be between the client and the CPA firm. So the AICPA, the best practice is to have an engagement letter that really acts more like a contract and specifies the nature of the work, the dates, kind of, everything that should be outlined in there so that the client is fully aware of what that CPA firm is doing. But again, some things that could happen is if they did not file timely, they did not discover fraud, or if there was errors, and those, again, would have to be fairly material, but that could result in a breach of contract. Negligence. So negligence, if you can think back to business law and ethics, is when you have a duty of care. So in this case, it's conducting the audit in accordance with the auditing standards. And then there's a breach of that duty. So they did not conduct the audit in accordance with those auditing standards. And then there has to be some sort of injury. So you can't say, well, they just, they breached their duty, but nothing bad happened. Well, then you don't have a case. So something bad had to happen, like the stockholders, the company then had to go bankrupt, or the loan was defaulted on, or, all the stockholders, the stock bottomed out and they lost their whole investments. So there has to be some sort of injury. And again, it can't be rumor of injury. It actually has to happen to the person. And then that the breach of duty had to be the cause of that injury. So there also has to be cause in there as well. Then there could be fraud. So fraud is basically like lying or, not preparing real financial statements. But there will be a misrepresentation or a lie about a material fact, and that the users rely on this misrepresentation to make a decision. And then again, it has to result in some sort of injury or loss. So again, most of these would be like financial losses. Then there could be constructive fraud when an inadequate audit was performed and they did not really have the evidence necessary to issue that unmodified opinion, and then they still do issue it. So again, most of our big international CPA firms are probably not going to do that, have a constructive fraud. They're really going to do their job, but then things happen, and like we said, it's no audit is perfect. So then what can the auditor come back to? So if there's a lawsuit happening, what could the auditor's defense be? What could they say? So they could say, well, they had a lack of duty, so that they listed out everything in the engagement letter and they lived up to all of those expectations that were outlined there. If the client had wanted them to do something else, it really wasn't a part of that engagement letter, they weren't contracted to do it. So they're going to say, hey, we really did everything that we were supposed to do. Non-negligent performance. So they performed the audit following all those generally accepted auditing standards, and they lived up to that prudent person or that reasonable person standards, what a prudent person would do in in their jobs, and they really didn't do anything negligent. If it was contributory negligence, where the client's actions also were to blame, so the clients, either their actions resulted in the loss, or they had like a deficient internal control structure. So somehow they, you know what I mean? It was how they set up their accounting business that this fraud really happened. So something like along those lines could be a contributory negligence by the client, or if the client ever gave false documents, or forged documents, or things like that they gave to the auditors during the audit. And then again, like I said on that first slide, that in order to have negligence, the not doing the, let me flip back there, the duty of care. So the duty of care, the breach of that duty, there also has to be cause. So they know that they have a duty, but supposedly they breached that duty, but then it also has to cause the loss. So just because there maybe was a breach, there still has to be that causal connection to say, well, it's because the auditor is the reason that the person suffered whatever damages that they suffered. I mean, and then like they give an example in the textbook that like if the client says, hey, I didn't end up getting my bank loan, which ended up costing me, some sort of damages or lost revenues or things like that. The defense would be that obviously the bank didn't renew the loan for other reasons that have nothing to do with the auditor's report. So then there really is no cause between those two. Then we get into our different federal securities laws. So we've got the Securities Act of 1933, the Securities Act of 1934, then the Securities Exchange Commission and the Public Company Accounting sanctions, and the Foreign Corrupt Practices Act and SOX legislation. So a whole lot of different like legal bases for these cases. And I think kind of the key to those is that, I mean, there's all different rules that the auditors have to live up to. And then there's all different penalties that then they could face, from maybe additional training to loss of their CPA license, possibly up to criminal liability, which would result in 20 years of prison. So then, again, the criminal liability is kind of the big thing, but then what our accounting profession comes back to all these cases and all this potential liability. So they're going to say there's some advice that's going to be given, that they need to reduce their exposure. So seek protection from frivolous lawsuits. Probably a lot of those cases either try to get them dropped or settle out of court. Improve auditing to better meet user standards, because again, we go back to what does that prudent person expect? So maybe make sure that we are completing all the audits up to what a prudent person would expect in those, by reviewing those or auditing those financial statements. And then educate, sorry, a little got a typo in this one, educate the users about the limits of auditing. So again, as if people understand that an audit doesn't go through every single transaction, there's level of materialities. So there could be things that they don't look at, that they aren't testing. So again, nothing's 100% covered and nothing is going to be 100% perfect. So as long as users understand that. Again, maintaining the standards and the rules that are set by the AICPA and the PCAOB. Establish peer review requirements. So again, the PCAOB requires those large publicly traded companies to have peer reviews once a year. So they're going to be looked at to make sure these audits are all being done in accordance with those standards. Oppose the lawsuits. So like I said up here, they do probably try to settle some of them, just to have them not in the public eye. But maybe, again, if they think they can win it, so even if they have to take it to court and it's going to cost more money. If they could win and set some of those precedent files, that might be a better way to do it than just to settle out of court. Sanction any CPAs or members of these associations for improper conduct if we find that they did not properly go through all the professional standards when they were conducting the audit. Lobby for changes in the laws. And again, like we said on that last slide, educate users. So people who are, the bankers, the finance guys, the investors, that these audited financial statements do not guarantee accuracy. I mean, it's not 100%. They're not looking at every transaction. They're not looking at every line item in the balance sheet. There's a level of materiality. If it's an individual CPA, like so just you as a person who's working in this industry, what can you do? Choose your clients that possess integrity. I mean, I think a lot of times do a little background check on these companies that are coming in, see who they've used in the past, how many auditors have they gone through, do you get a vibe that they are on the up and up, and there's nothing shady or questionable. Maintain independence from all of the clients, so don't start giving them accounting advice or bookkeeping advice or invest in their companies or be a part of their management team, anything like that. Understand the economy and the client's business, because a lot of times depends on what industry you're in. There can be very unique circumstances, so you can't necessarily, like if you've never worked in oil and gas, you wouldn't necessarily want to take on an oil and gas client because their industry is very unique. Perform quality audits to ensure that your work is meeting up to those generally accepted auditing standards. Document all the work properly and keep very detailed work papers, and then you keep those work papers for a specified number of years. Always exercise professional skepticism and judgment. And then carry insurance. I mean, even an accountant needs liability insurance so that they can limit their exposure. And then choose that legal organization. Even though CPAs cannot be a corporation, they could be an LLC or an LLP, a limited liability partnership. So something that could, again, protect them from liability if possible. Okay, so that is our liability, or kind of our legal side of our auditing textbook. Okay, thank you.